Hello, my fellow silver and gold stackers. Welcome back to Gold Rush Reporter, where we analyze the precious metals market with clarity, insight, and no hype. Today, we're diving into some extraordinary action in silver, including a new all-time high, dips in price, and why resistance is forming even as silver continues its bull run. If you've been waiting for a moment to buy or understand what's driving this market, this video is for you, and I'll break it down part by part. This morning, I was able to scoop some silver on one of the dips that occurred today. Silver's price had just reached a new all-time high, and while the excitement is palpable, we need to understand what's causing temporary resistance compared to other metals. It's critical to realize that dips aren't anomalies. They're natural corrections in a strong bull market. Silver's trajectory isn't linear, and short-term pullbacks present buying opportunities for those paying attention. As of today, silver is technically the worst performing metal on the charts, but don't be fooled by that label. Even with temporary declines, silver remains in a strong upward trend. It's heading toward $100 and perhaps beyond. However, the market is dynamic, and resistance today has created an ideal entry point for careful buyers. For instance, my friends at Summit Metals, our sponsor, are adept at helping buyers navigate opportunities to buy and sell. They are a reliable resource for anyone looking to position themselves in this rally. Looking at the numbers, silver skyrocketed to just shy of $96 today. The daily high was $95.99 with a low of $92.52. By the end of trading, silver had settled around $94.69. Showing some resistance after its brief spike. Meanwhile, other metals are also on the move. Gold reached another record high, climbing $88.50 to $4,161.20, while platinum surged over $95 to $2,480. Palladium gained $192 to $180.95, and rhodium rose $100, surpassing $10,600. The metals are moving in tandem, but silver's resistance is a story in itself, influenced by several market and geopolitical factors. Part of today's resistance comes from overnight trading in Asia, where new rules by the Shanghai Gold Exchange appear to be impacting the global flow of silver. These rules have created temporary friction in pricing, which ripples throughout the COMEX, LBMA, and other major markets. It's an early-stage effect, likely temporary, but it's worth noting that silver's movement is no longer only a function of US market demand. It's now deeply intertwined with global supply dynamics. Beyond the technical and market rules, geopolitical events are also fueling volatility. Tensions between the US and Europe are flaring over Greenland, trade tariffs, and diplomatic disputes, driving safe haven demand for precious metals. These events amplify market movements and create short-term resistance, but the underlying bull case for silver remains intact. Understanding these forces is essential for anyone looking to buy, hold, or strategize around silver's next moves. Let's dive into what actually happened with silver today and why the dip created an opportunity for buyers like myself. After silver reached a high of $95.99, it retraced to a low of $92.52. A significant intraday movement that caught many traders off guard. Moments before the markets closed, silver stabilized around $94.69, reflecting both natural resistance and the impact of external factors. Remember, this isn't unusual in a bull market. Corrections are temporary pauses in an overall upward trend. One major factor affecting today's resistance is safe haven demand triggered by global market jitters. The stock market has been under pressure recently, partly due to escalating tensions between the US and Europe. President Trump's push to assert influence over Greenland, coupled with threats of tariffs on European goods, has rattled investors. These moves have created uncertainty, prompting a rotation into gold and silver as protective assets. When equities falter or geopolitical risks rise, precious metals often absorb the capital fleeing riskier markets. To put it in perspective, Gold hit a fresh all-time high today at $4,167.20, up nearly $90 from previous levels, while platinum climbed $95 to $2,480. Palladium gained almost $2 to $1,195, and rhodium surged over $100 to more than $10,600. Despite silver's temporary underperformance relative to these metals, its upward momentum remains strong, and the bull market is far from over. In fact, the intraday dip offered a rare chance to purchase silver closer to $92.50, below the spike near $96. I personally acquired a 5-ounce piece of silver from my local coin shop, which had been held on layaway. The shop has been overwhelmed with incoming silver from other buyers, making it advantageous for collectors to act quickly. They've been stocked up, partly due to the rising market, and when I secured this piece, I avoided paying the full market appreciation. Additionally, I added proof dimes to my portfolio, which were available below spot. By combining these purchases, I managed to add a substantial quantity to my holdings without paying full market prices, a strategy that's becoming increasingly important as silver continues its rally. The broader context is crucial here. Geopolitical tensions, US-Europe trade disputes, and domestic stock market volatility are driving both institutional and retail interest in precious metals. Investors are no longer just chasing price. They're buying silver and gold as hedges against uncertainty. The recent volatility isn't a warning to sell. It's a signal to position strategically. Understanding the drivers behind the market is essential, particularly when movements like today's dip can be misinterpreted as weakness. Another contributing factor to today's resistance is the ripple effect of regulations and market rules abroad. Specifically, the Shanghai Gold Exchange introduced new trading rules that affect how silver flows internationally. These rules have created temporary friction in pricing, adding to short-term volatility in the US and global markets. While the immediate effect is resistance in price movement, it's unlikely to derail the broader bull trend. In essence, today was a textbook example of how a dip in a bull market can become an opportunity for disciplined buyers. Between geopolitical unrest, overnight trading impacts, and domestic stock market pressure, silver's minor pullback doesn't diminish its bullish outlook. On the contrary, it highlights the strategic advantage of timing purchases during short-term retracements, particularly when global supply constraints and industrial demand continue to accelerate. Now let's dig deeper into why silver's rally isn't just a short-term spike, but a structural trend backed by real-world forces. Industrial demand is a critical piece of this puzzle. Silver isn't just a precious metal anymore. It's a foundational component of modern technology. The solar industry alone is consuming silver at unprecedented rates. With the rise of TOPCon solar panels and next-generation photovoltaic technology, each panel uses significantly more silver than older models. Manufacturers are competing fiercely to secure supply, often paying premiums to ensure they can meet production goals. The electric vehicle market adds another layer of demand. Every EV contains more silver than its combustion engine counterpart, particularly in electrical connections, sensors, and battery management systems. With governments worldwide pouring billions into green infrastructure and clean energy initiatives, this demand isn't slowing down, it's accelerating. Beyond solar and EVs, silver is critical in AI data centers, 5G networks, and a host of advanced electronics. This isn't discretionary consumption. These are essential applications with no close substitutes. Meanwhile, global silver supply is struggling to keep pace. For 6 consecutive years, mine production has lagged behind industrial consumption, creating a structural deficit. Recycling helps, but it's not enough to bridge the gap. New mine discoveries are scarce, environmental regulations are tightening, and geopolitical instability threatens key supply chains. Large-scale deliveries into markets like COMEX, the LBMA, and Shanghai are signaling serious demand pressure. Vault holdings are declining, and coins and bars are being snapped up faster than refiners can produce them. Today's dip, while a short-term pause, doesn't change this fundamental imbalance. In fact, it highlights a crucial aspect of the current market. Deliverability and ownership matter more than price swings. Major buyers, including sovereign funds, industrial giants, and well-informed institutional players, are willing to stand for physical delivery rather than rely on paper markets. They're paying cash and securing actual silver, effectively removing it from circulation and tightening supply further. Geopolitical dynamics amplify this trend. Recent US-Europe tensions, tariff threats, and disputes over Greenland have injected uncertainty into global markets. Investors and governments alike are hedging against instability by acquiring precious metals. The effect is twofold. It increases demand for silver and gold while simultaneously reducing liquidity in exchanges. When a critical resource like silver becomes a geopolitical tool, traditional market metrics like daily price movements become secondary. Ownership and tonnage take priority. The combination of surging industrial demand, constrained supply, and geopolitical positioning creates a near-perfect environment for silver's continued appreciation. Even minor dips, such as today's 92.52 low, are opportunities rather than threats. Experienced investors recognize this. While retail traders might panic during volatility, the big players, sovereigns, hedge funds, industrial buyers, see dips as buying windows, further reinforcing upward pressure. The Shanghai Gold Exchange's new rules, which contributed to today's resistance, are a temporary ripple in a much larger trend. Supply bottlenecks, international delivery logistics, and rising demand from technology and clean energy sectors are far more influential. Once these short-term frictions pass, silver's trajectory toward $100 and beyond will resume. Finally, consider this. Silver isn't just catching up to gold. It's redefining its own market identity. Historically dismissed as volatile or secondary, it is now an irreplaceable industrial asset and a strategic reserve. Unlike gold, which can sit idle in vaults, silver is consumed, recycled, and continually demanded by global industries. Its role in emerging technologies, renewable energy, and national security ensures that every ounce has multiple competing uses. This makes it inherently less elastic to price manipulation and more resilient to temporary market dips. Now, let's dive into the trading mechanics that are shaping silver's current trajectory, because understanding these forces is critical for anyone following this bull run. One of the biggest factors right now is margin activity on major exchanges like COMEX. When margins are raised, it's not just about risk management. It's a coordinated way to shake out leveraged traders. Retail and smaller investors who buy silver on margin thinking they can ride a spike are often forced to sell during these adjustments. That selling pressure can temporarily hold silver back, creating the kind of resistance we saw today around $94, $95. But here's the key. The big players, the institutional buyers, sovereign funds, and industrial users aren't affected by these margin calls. They're paying cash, taking physical delivery, and accumulating metal regardless of temporary dips. This explains why silver can dip intraday, but still maintain a clear upward trend over weeks and months. These short-term pullbacks are essentially opportunities for major buyers to acquire more silver at slightly better prices. Today, for instance, the dip to $92.52 was brief, and silver rebounded quickly because underlying demand is relentless. Unlike gold, silver is heavily consumed in industrial applications, and demand won't disappear even if the price temporarily moves down. Deliveries are another critical signal. Recent COMEX and LBMA reports show record levels of physical silver changing hands. In the last delivery cycle, millions of ounces were removed from the market for physical settlement rather than paper trades. This isn't speculation. It's real metal leaving the exchange ecosystem. When you combine that with strategic accumulation by sovereign nations and large industrial players, you begin to see why the market feels tight, even at current prices. Supply is being absorbed faster than it can be produced or recycled, which naturally supports higher prices. Geopolitics continues to play a huge role. The tension between the US and Europe, sparked by trade threats and disputes over Greenland, is pushing investors into safe haven metals. Gold reached new all-time highs today, but silver, while slightly lagging, is following the same pattern because it is part industrial necessity, part strategic reserve. Meanwhile, disruptions in China, whether slowing GDP growth, trade restrictions, or export controls on refined silver, are tightening global supply chains. China accounts for a significant portion of refined silver exports, so any limitations directly impact availability in the West. We also have to look at market psychology. Retail traders may still be focused on short-term charts and daily price swings, but institutional and industrial buyers operate with a long-term perspective. They understand that silver's value is now tied to technology, energy transition, and national security. When these players stand for delivery, the paper market becomes secondary. In other words, silver isn't being held in exchanges to be traded, it's being secured physically, which further accelerates the bull run. Today's dip also highlights the importance of strategic buying and layaways. Local coin shops and trusted suppliers are seeing unprecedented demand, not just from individual collectors, but also from repeat industrial and institutional clients. Buying on dips, as I did today, ensures accumulation at slightly more favorable prices. But the broader market trend continues upward because the fundamental drivers, industrial consumption, limited supply, and geopolitical pressure, remain intact. Finally, silver's identity is evolving. No longer simply a hedge against inflation or a companion to gold, it has become a strategic, industrial, and technological metal. Its price behavior will increasingly reflect long-term scarcity, not just short-term speculation. Dips will occur, they are inevitable, but they are temporary corrections in a market that is structurally bullish. Investors and collectors need to recognize that each pullback is a buying window, rather than a signal of trend reversal. As we wrap up this update, let's zoom out and look at the bigger picture shaping silver's trajectory. Today's intraday dip to $92.152 and rebound to around $94.70 is a perfect example of how short-term volatility masks long-term trends. Silver remains on a sustained bull run, driven not by hype, but by fundamentals: constrained supply, record industrial demand, strategic accumulation, and geopolitical pressures. These factors make temporary dips less meaningful. They are simply opportunities for informed buyers to increase their holdings. The broader macroeconomic environment reinforces this bullish case. Gold hit new all-time highs today. Platinum is up over $90. Palladium continues its climb, and rhodium surged $100. These metals are reflecting both industrial demand and safe haven flows amid rising geopolitical tensions. The US-Europe standoff over Greenland, trade threats, tariffs, and broader international disputes are pushing capital into hard assets. Investors recognize that silver, while traditionally seen as gold's volatile cousin, now plays a central role in technology, energy, and national security, making it far less replaceable. Supply-side pressures are intensifying. China's recent export curbs, slowing industrial output, and a slowing GDP growth rate tighten global availability. COMEX, LBMA, and Shanghai Gold Exchange inventories are shrinking, and physical deliveries continue to outpace production. For 13 straight months, record levels of silver have been taken for delivery, rather than held in paper form. That's a structural shift. The market is being drained of physical metal, and the big players understand this. When sovereign nations, industrial conglomerates, and strategic investors take delivery, they are not speculating. They are securing critical resources, which drives long-term price support. Meanwhile, market mechanics like margin adjustments and short-term pullbacks only add fuel to the rally. Margin hikes shake out weaker leveraged positions, temporarily suppressing prices, but they do not affect cash buyers who are securing real metal. Today's dip is a textbook example. The small pullback was absorbed immediately by long-term holders and industrial buyers. Local coin shops and suppliers, like Summit Metals, are feeling the demand surge firsthand. They hold stock for weeks, but customers are snapping it up quickly. Even proof dimes and small bullion rounds are moving fast. Underspot pricing opportunities are disappearing as the bull run accelerates. The geopolitical and economic environment amplifies silver's strategic importance. Energy transition technologies, solar, EVs, AI hardware, and 5G infrastructure consume silver at unprecedented rates. Governments have recognized it as a critical asset. When combined with ongoing uncertainty in global markets, this transforms silver from a speculative metal into a must-have strategic resource. Price becomes secondary to possession. Governments, industrial users, and strategic funds will pay what they must to secure it. So, what does this mean for individual investors and stackers? First, understand that dips are not corrections. They are entry points. Buying strategically on minor pullbacks ensures accumulation before higher prices arrive. Second, follow deliveries and supply reports closely. These reflect real market conditions far better than speculative chatter. Third, consider diversification within silver. Rounds, bars, coins, and even proof sets. All are moving differently in terms of availability and premiums. Finally, maintain patience. This is not a short-term play. Silver's bull run is being driven by structural, long-term forces that will outlast fleeting headlines. In conclusion, today's price action is a microcosm of a broader trend. Silver's bull run is supported by structural scarcity, industrial demand, strategic accumulation, and geopolitical uncertainty. Temporary dips, margin adjustments, and intraday volatility are part of the process, not signals of a reversal. The market is entering a historic phase where silver is no longer just a metal. It's a strategic, industrial, and technological cornerstone. If you take away one thing, it's this: accumulate when you can, stay informed, and recognize that the fundamentals are overwhelmingly bullish. $100 silver is not a distant dream. It's likely a milestone along a much longer journey, and strategic buyers who act today will be positioned for tomorrow's historic gains. Thank you for watching Gold Rush Reporter. Remember to like, comment, and subscribe for ongoing updates, and stay prepared to navigate the market with knowledge, not fear.